All right. And we are live here on the Door Grow Show. And I'd like to welcome Jim Ingersoll out.
Hey, it's really nice to be here today with you. Thanks a lot for having me on an awesome show you've got here.
Jim, thanks so much. So, Jim reached out and he has this interesting sort of special niche in helping people get into managing rental properties or owning rental properties. And so we're going to have a conversation today about why property managers should also be owner operators and not just manage rental properties for everybody else. There's a lot more money in that. Does that sound accurate, Jim?
Yeah, absolutely true. I really love the property manager I use, but in talking to so many different property managers, they get stuck in this transactional income stream where they've just got to keep adding more rentals into their management contracts in order to increase their income streams. Mm-hmm. And they would like to break out of that and learn to be the owner and the principal in the deal, but they don't really know how to put the pieces together.
So what are so let's talk about that challenge. So this problem that property managers have, why are property managers not owner operators? Some are, but the ones that are, like, they usually are just owner operators. They're not doing it for anybody else. But the ones that are out there just managing properties for everybody else, and they maybe only have one or two of their own rental properties or none, what are they missing?
I think a lot of them get nervous because they don't know how to do the acquisition side. They understand, what a motivated landlord is like when they want to exit out of their property, but they don't understand how to connect the dots and to actually make the acquisition the right way. And one of the things I really like working with property management companies on who want to become principal owners is getting rid of that whole myth where you've got to have a 20% down payment and really strong bank funding in order to pull that off. You get rid of that myth and change that mindset a little bit, all of a sudden, they're able to make acquisitions and really build their net worth up and prepare for retirement, Jason.
Okay. So let's talk about that. So you say having 20% down payment is a myth. And you say that they maybe don't understand that the acquisitions, how that process sort of works. So let's break down some of these steps so that they can understand how they can make this work for them.
How about I'll give you 4 ways that it can be done, and we can pick any of these that you would like. The first one would be basically assuming or taking over somebody's loan. Another landlord that's already got it, they're just burned out, and they need to exit and they don't know how to do it. One of the things you can do is take over their loan. Another one is if you've got a long-term landlord who's owned the property for a long time and they own it free and clear. In other words, there's no bank loans on it at all. That owner could become your bank. A third way that I love doing is what we call joint ventures. And that's where we go out and what we do is somebody else puts up all the funding and we do the rehab and we do the long-term management. That's what, managers are good at anyways, but they don't use any of their own cash for that. And then the fourth way is, it's a little bit unique, but there's another big myth out there I want to break, Jason, and that's with retirement accounts, because we're so taught by corporate America that we can only invest in stocks, bonds, and mutual funds. But the truth is, you can also have your retirement account invest in rental properties. So if you've got money in a 401k, or something like that, instead of buying stocks, bonds, and mutual funds, you could use it to buy a rental property. So there's 4 ways. I'm not sure which one you sort of want to talk about first.
Okay, well let's just go from the top. So taking over somebody's loan. Now, doesn't that put like an incredible amount of risk on their shoulders if you're taking, you're taking over somebody's loan and you don't like completely get them off the paper?
Sure it does. Sure does. It does for the person that is selling you the house, not for you as the owner, because this works well when you've got truly somebody who's not just motivated to sell, but somebody who's pretty desperate to sell, and they don't really have any other options. So maybe they've got half a dozen rental properties and they're vacant, and they don't have the money to fix them up. to attract good tenants. See, they're sort of caught because they don't have the capital required to fix them up to get good tenants. They're vacant, and yet they're shelling out thousands of dollars on their bank loans every month. If you go to that person and they're truly motivated and you offer them debt relief, like I will start making that thousands of dollars a month payments for you. And then you come in, you provide the capital injection that was needed, you fix it up, you get good tenants and move on. So the key is the motivated seller in that case.
And so you're buying the property basically off of them. You're taking over the loan.
Yes.
Yeah. Okay.
And it's not really an assumption. We call it subject to. So you're going to buy it subject to the existing loan staying in place. So the way that it works is somebody's going to take a deed and convey the ownership to you. Mm-hmm. And typically when you do a real estate transaction, that loan typically gets paid off at closing. In this case, we're not going to pay it off. Instead, we're going to buy it subject to the existing lien staying in place. And instead of the person you're buying from making the payments, you're going to make them as the real estate investor or owner of the property.
Now, is that dangerous in that they could just later on kick you off the property and say, well, it's mine?
No, they're going to give you a deed. Now, you could do a lease option. That's a whole nother approach. That would be number 5 on my list, by the way.
Okay.
But no, they don't own the property, so they can't do that. They literally, in order for them to get debt relief, they're going to sign a deed and convey the ownership of the property to you.
Okay, got it. All right. So let's talk about, so that one works if they have the capital. If they've got some financial resources to do this, then this is it sounds like a great option.
Mm-hmm.
All right, number 2.
Okay, number 2 would be owner financing. You know, a lot of landlords are long-term landlords. I mean, I'm one as well, Jason. I mean, I love being a landlord. So what happens as landlords begin to age is sometimes their children and families start pressuring them to sell. Because sometimes there's kids that won't want 2, 5, 10, 20, 40 houses given to them after they pass. So the kids start pressuring them to sell. But the landlords really love having cash flow. And if you own property 10, 20, 30 years, you're going to have it paid off.
Right.
So they have this dilemma that they love cash flow. The property's paid off, so the cash flow is really good. But yet they've got this tension in their family or from some other source that says now is a great time to sell. I'm meeting a landlord later today, Jason, at 5 p.m. They have 5 houses that they've owned for a very long time, and the husband's starting to have medical issues. So they want to sell the package of 5. I'm hoping I get all 5 of them. But when somebody owns property for a long time, they've got it totally paid off. Instead of you giving them, say, $100,000 for the house, there's ways to structure it where you can creatively buy it. I could probably give you 3 to 4 different ways you could buy that house without needing a bank and potentially without needing much or any down payment.
Okay. So this, now this is the number 2 you said was the free and clear owner.
So that's owner financing.
Owner financing.
The owner will be the bank. That provides them with the comfort of continuing to receive cash flow without any of the property management responsibilities.
Okay. So, so a great question is, how are you finding these type of properties?
Well, I mean, you've got to do marketing, or you've got to have a really good referral base. I get a lot of my leads directly from referral. I've got I know lots of other people that will do everything from direct mail to bandit signs to calling for sale by owners. And
the message is basically, you know, do you have properties that you own free and clear that you're wanting to sell? Well, I mean, you're looking for motivation of a seller, and then depending on where they're at in the cycle of being a landlord, you may want to try to buy it subject to. You may offer them a cash price, or you may offer them to be the bank for you. One of the things when I'm negotiating for terms where I want the owner to be the bank is one of the things I ask them,
Jason, is like, what are you going to do with the $100,000 when we close in 10 days? And typically they'll be like, well, I'm going to put it in the bank. Well, if you put it in the bank, you throw it in a CD, I mean, you know you're going to earn, what, 1.5% interest at best.
Right.
That doesn't even keep up with inflation. So I will turn that around and say, all right, so you're happy earning 1.5%. How about if you finance to me at 5, 6, 7%? You can earn 5 to 6 times more and continue your cash flow coming in.
Okay, right.
So owner financing is number 2.
Okay. Number 3, JV or joint venture.
Yeah, I love doing joint ventures. They work very, very well. This is where there's 2 people involved in this deal. One person is the person who wants to own the property. They go out, they market, they find the landlord who's motivated to sell. So all of a sudden you've got an offer to purchase. But the problem is they won't take owner financing. You can't take over their loan. They only want cash. So say that number is $60,000. Well, the person that finds the deal could stroke the check for 60 grand to buy it. But I really like to encourage people to try not to use your own capital. That's the ultimate leverage when you're making acquisitions. So what you could do is go out there and find somebody who would really like to invest in real estate because they know it's red hot all across the country right now, but they don't have the experience. They don't know how to find a deal. They don't know what a deal is. They don't even know how to manage the property, which is what your listeners are experts at. But they've got money sitting on the sidelines. They might be nervous about the stock market. It could be sitting in a CD. Maybe it's a small business owner. And what you do is you come together on that deal, and one person does the work, one person injects the capital. It's sort of like Shark Tank or venture capital, I guess, Jason. And one person does the work, one person provides the capital. And then what you do is you share the monthly cash flow. And someday when the asset is sold, you share the upside on that as well. That could be 60-40, 50-50, 70-30, or whatever you sort of work out. Works very, very well.
Now, if you have quite a few of those, doesn't it get kind of challenging to manage and to know everyone that's being paid out and this sort of thing?
Yeah, I mean, you do have to have systems. No different than a property management managers that are listening right now. You've got to have systems too, because you've got to be able to market for tenants. You got to screen for your tenants. You got to have leasing. They've got to be able to make payments online. Mm-hmm. You've got to pay back to your owners. I use Buildium. It's a great system for all of that. Right. If you're going to go into acquisitions and become the principal instead of a manager, you've got to have systems for payables and things as well.
Yeah. So instead of just paying out, a certain percentage for this, you're pulling in a lot more and you're keeping a lot more, and you're just paying out, maybe half out back right. to the person that.
See, one of the dilemmas the landlords run into, even with like a 20% down payment, is your cash flow can be pretty tight, particularly if you're in New York or on the West Coast or somewhere else. It gets tight because you've got to pay the bank mortgage every single month. What if you don't have a bank mortgage and you're just sharing the cash flow? So if you collect, say, $1,800 of rent or $1,000 or whatever it is, you just subtract out your escrows for taxes, insurance, and the rest is purely cash flow because it doesn't go to the bank. You just take whatever's netted and you divide it however you agreed. So just as a quick example, let's say that you're renting a house for $1,200 a month and you have $200 a month because the numbers work good in taxes and insurance. Here in Virginia, the numbers are not too dissimilar to that. So you're going to net $1,000 a month. Now, out of that $1,000 a month, let's say you're joint ventured on a 50-50. So you keep $500 a month and you send off $500 to your joint venture partner per month. Mm-hmm. Okay. Yeah. And so both parties come out pretty darn good on that example. For the principal owner, for every 2 of these types of deals you do, basically it's like having one free and clear house because there are no loans on these properties. There's just a joint venture only, and you're literally sharing all of the cash flow because there are no bank mortgages on it.
Fantastic.
Works very, very well. And you get into that deal 100% with none of your own money. So your partner puts up all of the capital for the acquisition, all of the capital for the rehab and renovation. And by the way, if you have a vacancy, you don't owe anything. So there's a lot of benefits to owning property in joint ventures when you want to go that route.
That's a fantastic model for property managers. So if because they're out there, they can go out and find these properties they know would make good rental properties.
Right, they do.
They already have all the marketing. They have all the tenants coming to them, and they know which properties could be rented out if they were fixed up. They know what it takes to get them rent ready. And if they they can go to this investor and say, hey, I found this great property. We just need to purchase this thing. If you want to put up the capital to purchase this thing, we'll manage it and we'll rehab it and we'll split the profits every single month.
Right. So the benefit to the owner is increased cash flow, no banks, no down payment, and less risk. And the benefit to the financier who puts up all the money is they get involved with real estate without having the experience of it and less risk as well. And still make a great return secured against Main Street instead of Wall Street.
Right. So no, that makes a lot of sense. And I think property managers, it's kind of a natural fit.
I do too.
They can go out and find the property, and nobody's more qualified to get investors into new properties than a realtor that is runs a property management company.
Yeah, I agree.
So that would be a fantastic fit. So let's talk a little bit more about that. This joint venture, how does this actually happen? How can they get started doing something like that? They've never done it before.
Okay.
Properties, maybe they've done some real estate and they've done real estate deals. How do they make this work?
Well, if you find a good deal, it's easier to find the money. It's easy, and the people with the money don't know how to find the deal. The people with the deal don't know how to find the money. But the truth is, when you have both sides come together, there's a lot of synergy, and you can get the deal done very, very fast. There's no underwriting. There's no appraisals. There's no fuss, no muss. You can close in 10 days or whenever you want to bring the money to escrow and get it done. I think the key starts with finding a really good deal, and then knowing some people who might be interested in participating in that deal. And there's a lot of private practice owners, there's small business owners, there's people with retirement money sitting on the sideline. So there's a lot more money out there available for real estate deals than people think. If you've got the skill to find a good deal and manage the property the right way, which is all of your listeners are great at, by the way. Mm-hmm. That's what scares people, is being the landlord, right?
Yeah, nobody wants to be the landlord.
I love being a landlord.
Yeah, most people don't like being a landlord. I know. They want peace of mind. And the second they see the tenant's phone number on their cell phone, like, oh my gosh, right?
Right. So this is a very passive way for people with some finances to jump into the real estate market that's red hot right now.
Yeah, and there's a lot of people that would love to get involved and get into real estate investing, but they feel like, man, I'd have to go get a degree in real estate or something in order to figure all this out. And they probably don't trust the average real estate agent because they're going to be serving their own interests. So this sort of model is genius because this property manager person that's going to be finding the property and structuring the deal and managing the property is going to have skin in the game in this, and they're going to be involved in this, and they're splitting the rental property. So they have a natural incentive to make sure the property is always going to be rented out and it's going to be well taken care of, and that they're getting in a good amount of rent. It's a natural built-in incentive. So yeah, it makes a lot of sense.
Works very, very well for everybody involved. And that's the key with all of your deals is everybody's got to do well.
Right. Now, on those JV deals, would you, because let's say they're nicer areas, more expensive properties. It's kind of, maybe it's difficult to find an investor that can foot the whole bill to rehab that one property. Would you recommend doing multiple investors, on a single property? Or does that get a little too hairy?
Yeah, I would be a little careful of securities in that case. I don't think you really need to pool money. You know, if you're working with people that don't have very much money, maybe you want to invest in a mobile home on land, or something a little different. Maybe a 2-bedroom instead of a 4-bedroom. Or maybe instead of investing in LA, maybe you want to go to South Bend, Indiana. Or maybe you want to go to Pensacola. Or maybe you want to go to Detroit, where there's great cash flow.
Okay. So now number fourth item, you said retirement accounts using a 401k. So how could these property managers help get their existing owners to recognize this? I think this would be great for them, and it'd also be great for them to get their owners to get more properties. They want more properties, bottom line.
They do. So one of the things that we're taught in America is you can only take your retirement accounts and invest in stocks, bonds, and mutual funds. And that's because the people, the financial planners and all those folks, they enjoy selling those products, and they make good fees on mutual funds and things like that. There's this little niche in retirement accounts that's growing extremely fast, and it's called self-directed IRAs. It really seemed to start taking off when people saw how Mitt Romney was doing it when he ran for president 5 years ago. Mm-hmm. They were seeing he was doing all these deals in his self-directed IRA, and he had a gigantic account. And everyone's trying to wonder, like, how can Mitt Romney be investing in businesses, real estate, other assets, when I'm told all I've got is stocks, bonds, and mutual funds? And you can take you can roll over or start a new account with a self-directed IRA custodian. The one I like to use a lot is Quest IRA. Equity Trust is another good one out of Ohio. And these are folks that will allow you to grow your retirement, and you as the account owner can self-direct it to anything you want. So you could invest in stocks if you wanted to. You could invest in another business. You can invest in real estate. You can invest in notes, or a wide variety of other things. Truly, the owner of the account has a ton of freedom to invest any way they want, including one of the things you can do is you could take your retirement account and you can buy a rental property. So, a lot of people have, say, $100,000 sitting in a 401k or a retirement account. And if you get tired of earning returns from the stock market, you could take that and go buy a rental property. And then your tenants, it would go through your property management company, would actually just make the monthly payment directly to your account. That's how I've been doing it. It works very, very well. So once a month, my property manager will collect the rent, and then he just sends it direct to my retirement account. It works extremely well. You can do that in a Roth IRA. You can do it in a traditional IRA. You could do it in a SEP. I also do it in an HSA because, health insurance is a big deal now. So imagine, with very high deductible medical insurance, $5,000, $6,000, $7,000 a year. What if you had an account called a health savings account that owned 1 or 2 rental properties? That could fund your medical expenses the rest of your life.
So you've got like a handful of accounts that are or properties that are basically your health savings account.
Sure.
Yeah.
You could do it in a Roth IRA, a health savings account. You could do it in if you don't have any employees, you could do it in a solo 401k. There's like 7 or 8 different types of accounts you can do this deal in. And each of those accounts can invest in rental property. You could buy a note. You could do private lending and a lot of other really creative transactions that allow you to escape Wall Street if that's what you want to do.
All right. So this is some really cool info. That's really interesting. Now, you had mentioned that there was the 5th, but it's probably not a great option, right?
Sure. You could pay cash.
Oh, you can pay cash. Okay, yeah, you can pay cash.
Or you can put 20% down and go get a loan.
Yeah, the typical sort of thing.
I don't want you to do that. Don't use your own money. Real estate should be leveraged. It's a huge benefit.
Oh, yeah, and one thing, and you're talking about like long-term rental management.
Yes.
Yeah, and so one of the things I've also seen some of our clients do is short-term rental, vacation rental management.
Oh, yeah.
Which is really high margin. usually. So they
I
make,
love them.
yeah. So do you have any of those?
No, but I'm working on it.
Okay, yeah. So so I hear like if you get these properties in a
Yes.
good area, but they tend to need to be really like high-end properties, like big properties.
Not necessarily, because the reason they're not legal everywhere in the United States. So you got to watch your local ordinances. But I know people that are doing them with like traveling nurses. They're doing them with people that are building homes. And it could be vacation. It could be at this time of the year, people coming in for college graduation,
Oh, that's a good
sporting
point.
events. I mean, think about all this opportunity that's out there. And instead of earning, say, $1,000 a month, you might earn $2,000 or $3,000 a month and really jack up that income using Airbnb, VRBO, and a lot of other great sources.
Yeah, fantastic. Okay. So this is all really fascinating stuff. So Jim, so tell everybody like what it is that you do and then how they can get a hold of you.
All right. Well, I'm buying a lot of property. I'm a landlord, and I'm doing a lot of flips and a lot of rentals. If you want to connect with me, I've got a free gift for your listeners. Just go to bigmoneyinvestor.com/free, FREE. bigmoneyinvestor.com/free. You can pick up a little investing kit and get started.
Fantastic. And so, so reach out to Jim if you're curious about some of the stuff that he spoke about today. And Jim, I appreciate you coming out here on the Door Grow Show and dropping some knowledge for the property managers out there. And any parting words?
Yeah, just for your property managers that are out there, instead of making all your landlords rich, it's time for you to grab the reins and do the same thing. You've got great income with all these all these rentals, but you need to work on your net worth and your equity. And becoming a principal will take you from A to Z. Get it done.
Yeah, don't just help the investors, be an investor.
Right.
All right. Thanks, Jim. Appreciate you.
All right. Thank you very much.